Hey guys, welcome to our webinar. We are going to be starting here in about a couple minutes, or no, less than that, about a minute. We'll get everybody settled and make sure everybody can get in. And we're almost there. Today we had, in our building, we had mechanical, not problems, but I guess things they had to do for maintenance, and the power's still out. So I had to jump some cables around my office, and we got things going here together. All right, so we're okay. Okay. All right, so we're going to be talking about managing threatened trades, and those are really important just because it's easy to put on a trade and take one off, but when when a trade gets threatened, it's not comfortable, and you want to have a good plan in order to manage that so that you come out profitable, and that's what we're going to be talking about. Okay. Hopefully you're going to learn a lot today, and you're going to bring a lot of value, to your trading, just by the things that I've discovered over time, and sometimes that uncomfortable stuff are losses, and it's important to get through losses in order to learn, and that's how it is with everything, right? So in any case, let's get started here, and we've got around 50 slides to go through, and we're going to get to all the questions that you have. Just want you to be there and write down your questions, because we want to get through the slides and get to your questions there. Okay. All right. So what are we going to expect here from this webinar? I'm going to be showing you how to make consistent returns monthly based on margin capital at risk by adjusting trades without taking large losses and make profitable returns. Okay. So what we'll learn is, number one, how I went from taking 0 DTE 3x losses on a lot of trades to very few losses in several months. Okay, so our performance is really, really good on 0 DTE, and hopefully it'll stay that way. How to identify strikes and strike prices that you'll use to increase your chances of profitability. How best to mitigate a trade that is threatened, and that's the main thing that we're going to be talking about. And capital requirements to manage in the money and out of the money credit spreads, and the best time to widen spreads to gain an edge on a position. Okay, so stay with me till the end. I have a special bonus for you guys, and I think you'll like it. And so let's get going here. So I put together 3 reasons why you might want to be in this webinar. Okay, the reason number 1 is you're interested in learning new strategies that will take your trading performance to the next level, so that you can finally leave that 9-to-5 career behind. Number 2 is you've seen, heard about, read about, and others making money, and then you can do it too, but you've just not seen the account grow based on your goals. Number 3, you've tried different trading strategies that you thought, okay, this is it, only to discover that it's just not getting you to the place of consistent results. So with that, show of hands, virtual hands, right? For which one is most in tune with you. Number 1, interested in learning new strategies. Number 2, seeing your account grow month after month. And find the right strategy that provides the great trading results. Okay, so let's see here. Don 3, Robert 1, 2, 3, Ken 3, Mamdu 2 and 3, Dave. Okay. Hey. Okay, great. All right, thanks, guys. Perfect. Okay, so I'm a regular guy, and I live in Puerto Rico, and it's pretty cool to be here. It's my kids on the left-hand side, all grown up, and my parents a while back in MBA program that I had. So love trading. I was in technology for a lot of years in management, and then I decided that the career stuff is I just wanted to do something I wanted to do, and that's trade. Okay, so let's focus in on mindset. Okay, so let's imagine what it would feel like if most of your trades were winners month after month, and you would be confirmed by watching that size of your account grow month after month after month after month, right? That's number one. Number two is becoming the trader that no longer takes large losses but consistently trades according to a proven trade plan that is profitable over time, allowing you to grow your account month over month. So those are really important factors, and it's not all about it's not all about being positive and everything like that. It's really just taking it in stride, and you're going to have losses and you're going to have gains, okay? And the thing you need to do is have more gains than losses, and that's how we get through this, all right? And so, okay. So let's go through what an SPX credit spread is, all right? And some of you may not know what that is, but we're going to define this, right, to make sure. So a credit spread has a combination of 2 puts and 2 calls, where the put and call is sold. That's sold is more expensive than the put and call that is bought. That means you get, when you place this trade, you're actually selling a position. The trade, the position is going to go into your account, and you're going to get a credit on it, or right before, as you trade that trade. Okay, so the 45.50, 45.40, these are the verticals. Okay, they're called verticals because one sits on the other, and the 0.50 is multiplied by 100, so you get $50 on this trade, and that's the biggest gain that you're going to get by having this premium. Okay, so you're selling the 40.50 put, and then you're buying a 40.40 put. Okay, so that's where you get that credit, and this is called basically a high probability trade. However, on the downside is the risk reward on this trade is not very good. So basically, on this trade, you're gonna risk $1,000 to gain $50. Okay, very bad risk reward. However, the profitability, or the probability is that you're going to be rewarded many times on these trades. Unless you don't manage them correctly, and then you can get into big trouble. So max loss on this position is $1,000, which is also the margin requirement that you need to get that. Okay, all right. So there are profitability factors that we're going to talk about that allow you to have an advantage on these kinds of trades. So it basically gives you an edge. All right. So this is a SPX call chart, and it goes from 68 to 0 days, and as you can see here, the market, if all things were the same, right? If the market just stayed in the same place, this is what would happen. Okay, you would decay until your expiration's gone, and so from 68 days to 33 days. The rate of decay is 34%. From 33 to 5 days, the decay is 57%, and from 5 days to expiration, the rate of decay is 100%. And so the closer you get to that expiration, the faster the decay happens. Okay, so let's talk about the profitability factors. So we talk we look at the implied volatility. Implied volatility is basically something you can't see or hear, but what happens is the factors in options, right? When the market begins to open, the volatility is most of the time bigger than the rest of the session that you come in. Okay, and so when I place a 0 DTE trade, I place it right at the beginning of the market to capture that implied volatility. Okay, and then from there, it's basically, you know, it's furthest from the market from there, because you know, we're putting on a call spread and you're putting on a put spread, and then when the market begins to function, right, depending on how it goes, if the market just goes straight up, right, you're going to be in trouble, and then you're going to have to mitigate that trade. However, most of the time, you can stay in that range, and the market and basically the positions go away, and you collect that premium, and that's really the goal. Okay, and it happens most of the time. So volatility is really, really important, especially at the beginning of the session. All right, number two, profitability number two is part of the Greeks, and it measures the decline in the value of the option due to the passage of time. So that's what we just talked about, right? Basically, we talked about 68 days, but we're talking about now 6 hours. So when you're trading 0 DTE, it's really a 6-hour time frame, and you get in and you get out, and you're done. Okay, and so the time frame for that decay is very, very quick, very fast, especially if we start with a high, you know, a high volatility environment, and the market cools down. That's just the sweet spot, you know, for these types of trades. Okay, and I love these trades. Use them short term. Also use options on futures overnight, and we'll talk a little bit about that as well. Okay, all right. So the third profitability factor is really market direction. So if the market is trending up or down, okay, you know, as the market goes up and you have a put spread, the decay is going to go very, very quickly, you know, to go down on the put spread. However, on the call side, you're going to have possibly a threatened trade, because there's a market that's moving up. Okay, so most of the time, the market is moving sideways to up. You know, there are times that obviously it goes down, but those are seldom. But either way, I can tell you, and I've been trading 0 DTE for 5 years. Okay, and I've structured these trades many different ways, right? And today, basically, I close out a trade that's you know, that's a bear spread, that's threatened. You know, I close that out, and then on the bull side, on the bull spread, I roll those trades. Okay, and that's what's worked really, really well for me for a long time. Okay, so moving on here, let's talk a little bit about pattern day trade, because that's important. So if your brokerage account is more than $25,000, you're good, you're fine. If you're not, then basically you could be restricted by having day trades or 3-day trades in a 5-day period. So you want to stay away from that, because you can get restricted to where they will not allow you to trade and only close your position. So you definitely don't want to get into that situation. Okay, all right. So again, 3-day trades within a 5 consecutive day period. you're fine. If you go to the fourth, you're going to be restricted, and it's not fun. But if you have a $25,000 account, you're good. Okay, so how to avoid pattern day trader? Number one, limit trades to one trade 3 times a week. If you do that, you're going to be fine. Manage trades from multiple accounts. That works. Trade wide iron condors. That gives you further space out, right? But still, you could get in a very high trending environment, and you still have to cut your losses or roll it. Or you can trade ES options on futures, which there's no PDT restriction, and they're very similar to SPX positions. Okay, so you can interact with ES trades, and it works the same way with volatility and everything else. Very similar to SPX, but you don't have that thing on your back, that you're going to get restricted. ES futures work. Okay, so let's get into the management of these trades. We're going to talk about out of the money, in the money, same strikes, lower strikes, widened spreads, see, do we have all of them? And then moving positions out further, okay, to avoid getting threatened. Okay, so let's talk about the entry, exit, and threatened position here. Okay, so when you enter a position, you want to enter between 1 and 10 minutes, and actually I get in around 5 minutes. Within 5 minutes. Sometimes it's about 2 or 3 minutes when I put on both positions already, and it's really because I just want to grab that high volatility environment. Okay. The wider the spreads, the greater the distance to the market. Yes, it's less risk. However, the price, if you widen the spread, you'll have additional margin requirements, and it's a higher risk. Premium should be between 45 and 90. I actually most of the time use between 50 and 75. Probably 95% of my trades are that way. Okay, so they work. Take profit. You can take profit 10 cents. Usually, if let's say the market is within range the whole time, you'll probably be able to get out of that trade around 1 o'clock, 1:30 in the afternoon. If you want to wait a little bit longer to get out at 5, at 0.05, you're going to wait about another 2 hours to get out of that trade. Most of the trades that I do, and the people that work, that trade with me, basically we take it to the expiration day, the expiration time. And the reason for that is because we trade with traders that don't have $25,000, and so I do as much as I can to help you to get to that place where you don't have to be restricted with PDT. Okay. Okay. And as far as losses or rolls, okay, typically in a month, and I actually worked on this, okay, typically within a month you'll get threatened enough to where you'll have to roll a trade or cut your losses around 3 to 4 times in a month, and that's trading with 20 days, right? Monday through Friday. So it's a pretty good profitability. It's a pretty good probability that you're going to be good with these, all right? Because most of the time when the market when the market gets really heavy or moves quickly, it's typically going down, and then you can roll that trade, and it's much easier to roll and manage a bull spread than it is to manage a bear spread. Bear spreads can be really, really hazardous to you, so you got to be careful with those. Okay, expiration, we just mentioned that, and exit trade when threatened, using a 2x or 3x stop loss scenario. And so what that means is that when you put on let's say you put on a put spread, and the premium is 50 cents, right? Or $50 with one contract. The position that you want to close your trade at is no more than 3x. And so if you have a premium of 50, you multiply that by 3, you get to 3x, right? Which is $1.50, and that's where you cut your losses. Or you can go to 60, and you go to 180, right? So that's how we measure these trades to get out of them, to take stop losses. All right? And a lot of people have asked me about that. Roll a trade near the money or above the money, and we're going to talk a lot about that because it's much more preferred to be out of the money than in the money. Okay, and we're gonna see why in a few minutes here. So rolling a trade that is in the money by widening the spread, you can do that, but it's still, you're allowing yourself to get additional margin, and that can get scary, especially if you're doing a lot. Okay, so let's see here. So these are the distances from the market on a 22 VIX. 22 VIX vertical, not vertical. 22 VIX volatility. Okay, so the green is the call side, and the red is the bear side. Okay, so you can see how much more the distance is from the market for a call spread. Oops, sorry about that. From a call spread to a put spread. So you go from 5 to 10. You see, you get a pretty good distance away from the market, and then you go to 15, and you get some distance, but not a lot. And the more you go out and widen those spreads, the less you get the bang for the buck. Okay, so that's why I've done it. I've done it with 15 wide. I've done it with 5 wide, and I really like the 10 wide. I do want to say that if you're trading 5 wides and you intend to widen them, you can really widen them. You can really take them away from the market. Okay. And it's much easier. So that's one of the benefits of trading 5 wides on 0 DTE. Okay, so here's an example of the VIX 27. Okay, so you can see here, this was the VIX 22, 0 DTE. This was the VIX 27, and you can see how much more distance you get from that kind of increase in volatility. And then you go to 1 DTE at 27, and isn't this weird that the 1 DTE is closer to the market than a 0 DTE at the same volatility? When I saw that, I thought, what? This can't be, but it is. This is exactly what it is. So if you're trading 1 DTE, you're actually going to get closer to the market, in alliance with 0 DTE. It's pretty weird, but that's how it works. That's how it is. All right, so let's go through real scenarios here for what happens when you get threatened on a trade. And this is the cool stuff, right? This is the stuff that you really should know and understand, because when you get threatened, it's not fun, okay? It's not fun, and you need to know what to do in order to get through it, okay? All right, so here's a trade a while back, long time ago, but it works the same way for many years. Okay, so here we put on a 35.75, 35.65, and you got a threatened trade here now. Okay, so what can you do? Well, because you're out of the money still, you can roll that trade to the next day, and you'll get $1.75 of credit for that just by rolling it to the next day. Okay, so that's nice, right? You get a nice big credit. But what you really want to do is you want to get it away from the market, so you want to push it down. So here's pushing it down. So you go instead from 35.75 to 65 to 30.50, right? And you get 25 points of distance from the market and a 35-cent credit. Pretty good. You get two bonuses, right? For that. You get the 25 points and you get the 35 credit for that. Okay, now we're going to go to the next day and widen. Okay, so we're going to widen this spread and take it as far as we can to get a credit, and that's what happened. So we went from 35.75 to the shorts on the short strike to 35.30 on the short strike. But remember, we widened this thing to 15, right? So we have a long way to go. 45 points, and you get a 15-cent credit. Pretty cool. But remember, when you widen, it just exacerbates, and you have to really be mindful of the margin requirements that you have. Okay, so now same strikes 2 days out, and this is pretty cool. You get $2.15 instead of $1.75 on it, and 40 cents higher credit. Okay, basically. So rolling 2 days out is cool, because what I like to do too, when you roll it out one day, and you put an opposing position on, right, to get more credit, it's close to the market. So when I roll a trade, when I roll a 0 DTE trade, I roll it out 2 days, and then I put on an opposing spread on it, and that way I can get additional premium for that trade. And actually, when you do a 0 DTE trade, right, and you roll it, you're actually getting more money, for doing this, for those trades, as long as you manage them correctly and keep them out of the money. You're going to make more money than you would just having a 0 DTE trade. Okay, and this happens quite a bit, like those days where I just mentioned, right, that we have to roll those trades. Okay, so now we're here at zero widen 2 days out. Okay, so this is widen 2 days out, and now you're going from 35.75 to 35.15 for a 35-cent credit, and that gives you 60 points and 35 cents for credit. So you're really getting some distance there, for that, and then especially if you put on an opposing position, then you'll have a lot more premium on there, and that gives you a cushion for trading these. Okay, so now you have a widened trade 2 days out, and so this is widened out. So we're actually 100 points from the market, and with a credit. So pretty nice on this. Okay. Okay, now we're going to same strikes next day, and this time it's in the money. And you don't want to be in the money, but sometimes it happens, especially, you know, sometimes the market can really run, you know, and you're having to get, you know, scrambling to get that, you know, to get that position in, and, you know, sometimes it happens. So you just have to deal with it. All right, so here now, with the same strikes, you're actually getting a 90-cent credit, 90-cent debit. So that's a big change from $1.75 to 90-cent debit, right? In the money. And these are the same strikes. So not fun, because what happens is you're going to eventually have to probably widen this spread in order to get you know, back to profitability. So rolling in the money credit spreads will always give you additional debits, you know, to manage. Okay, so let's go same strikes next day in the money again, on the put call, on the put side, and this time we're not going to we're going to push it down, okay? And you can see here that debit went from 90 to $3.03, okay? What was that? Was that I had? Yeah, 90 cents instead of $3.30. That's a lot. That's very expensive. So that's what happens when you're in the money. So have that, you know, have that sinking in to your head, okay? When you're thinking about it, write it in your trade plan. No in the money trades, all right? And I've traded these, you know, a lot, you know, and it's just not fun at all. It's just a struggle to get through that. All right. So so keep that in mind. All right. In the money, roll down, widen next day. And I can tell you too that if you're doing these with, you know, right now we're looking at puts, right? If you're doing this with calls, the calls are just really bad, you know, really hard to manage. So just keep that in mind too. All right, so let's look at this now. Widened next day, 35.75. So it's a zero credit here, but at least, you know, you're not negative. Then you're basically 15 points away from the market with a widened spread. Okay, still close to the market, but at least it gives you a little bit of breathing room if you're in the money. All right, out of the money, 0 DTE, lowered strikes, 1 week out. 1 week out, these are cool. So you go 1 week out, you get that 10-cent credit on it, okay? And you're going from 36.90 to 36.20. What is that? 70 points, right? Yeah, 70 points. And it's a nice way to actually convert that to a 7 DTE trade, and that's what you would do to do that if you're going to push it a week out, right? So you're initially you're basically getting a 0 DTE trade a week out, and now you're going to manage it as a 7 DTE trade, okay? And obviously the deltas are not going to be the same, you know, as a regular 7 DTE trade. So regular 7 DTE trade, you're trading around 12 to 14 delta, and with a threatened trade that you roll out, it's probably going to be about a 25 delta, you know, for that. So yes, it's a little bit riskier. Okay, out of the money, 0 DTE, rolled down, widened, 1 week out. Okay, this one, we went from 36.90 to 35.75. That is a long way out, okay? So when you widen this thing, you're really going to be pushing it out there. So what's that number? 36.90 down to 35.75. So it's like 120 points or 125, 115 points, something like that, out there. So that gives you a lot of distance, and probably it's it's the best way to do it. If you're gonna if you're not gonna be if you're gonna be out of the money, and then just manage it like a 7DTE trade. All right, so let's talk about 7DTE and exits. So when you enter small positions, I try to enter them just like I do 0DTE. Okay, the entry should be done with volatility a little bit higher. And that's just the way that it should be done. And I like to place these trades just like I place 0DTE, okay? Because I get those implied volatility, and I like to do it right at the beginning of the market. So I take a 10 to 12 delta for the bull side, 7 to 10 delta for the bear side. You will get a this is the normal premium for the 10 to 12, depending on volatility. And then you'll get a little bit lower on the on the call side, so to get a little bit more distance. Okay. So exit, take a profit. You want to close that trade. You want to close that trade earlier than you normally would. If you're profitable. Normally, I take them down to 10 cents, but you want to take it up to like 30, 40. Cents, close it out, and move on. Okay, because you may be riding that thing for a while. So for positions that you have rolled and adjusted, profit target should be 20 to 50% instead of 80%, and that's just the right way to go. Adjustment on the rolls. You want to initiate rolls around 40 points away from the threatened strike. So these are for 7DTEs, okay? So that's how you stay solvent here, and keep doing it. If you have to roll again, and keep that 40 point distance that's out of the money, okay? A lot of guys just say, let's just wait, it's better to to be preemptive than to get in the money. Okay. Stop loss, good. Once if you've got a bear spread and you're rolling that thing, you definitely just want to get out of that thing. You don't want to take that and over and over and over again. And at the beginning of this year, we had some of those, and it's just a bear, man. It's really bad. Okay, all right. So kind of a rule: call side stop loss should be considered after about 2 or 3 rolls, so you won't get into big trouble. All right, on this one here, this is a regular position that you put on for 7DTE, and you can see here the range is about 300 points. It's depending on volatility, okay, but these 7DTE trades are really good, really great, because you can manage them early and do good things with them. All right, so that covers the technical part of this session. I wanted to share with you the fact that I do have a trade alert service. We trade these types of trades all the time, and you have the opportunity to learn while you earn. Okay, and we help you with how to position these trades, put them on, adjust them. Okay, and you'll learn. I mean, you will learn. While you're doing this, really, really well. And of course, you can actually become or start becoming a consistently profitable trader. And who wouldn't want that, right? Of course we want that. So we talked about interested in learning new strategies, desire to see your account grow, and find the right strategy that provides consistent trading results. This is the place that you can get that. All right. Now, a lot of guys come in, and they learn as much as they possibly can. They stay there for about 3 months and they take off, okay? Because they've learned. They've learned and they're on their own. And that's great. That's exactly what we should be doing, right? However, are you gonna keep doing what you're doing? And you're gonna hope that one day it's gonna stick? It's not gonna happen. It happened. I went through that for years, and it didn't happen. So, if on the other side, are you going to finally take those steps and do what really works, and it works consistently? You have a no quit attitude, commitment, discipline, having an edge, and multiple edges. Especially when you're in a community of people that know what they're doing, they're trading for a living, and they're sharing their thoughts with you. Okay, so you have free mentors. Okay, in this scenario, and this leads to success, guys. Right. So our trade alert service, we use, and we have two ways. Right. We use one-way communication and two-way communication. So two-way communication is for when people are asking questions and all this. When we have the one-way communication, it's really for the trade alerts. Okay. So so here's back and forth talking about what we do. And then when we go to the trade alerts, you can see that it's just really, really tight, and it shows you, we have the posts, where you should be. We give you the adjustments in here, and it's very, very clear for what to do. Okay, so we have great trader success stories. You can get through those. And they keep coming. So we also have a guarantee. Okay. So if you subscribe for 1 month and lose money by following my trades, I will refund your subscription by 125%. Okay. So I've been at this thing for about 5 years. I've never had to give money back. All right. Because it works as long as you're taking the trades that I'm putting on. All right. So here's the offer, guys. We're going to be open until the end of this week, and then we close our doors. And the reason we do that is because we do the marketing, and then the people come in, and then we get a lot of questions. We answer all the questions, and that's the time to do it. It takes about 2 weeks to push that through. Everybody gets acclimated, and boom, we close, and we focus on our traders, and that's what we do. So here is the offer, and you can see it here that you get $20 off for life. We have 3 tiers. One is the monthly trade. The second is the monthly 0 DTE and 7 DTE and premium trades, and then we have the 109 plan, which includes live trade rooms, futures, and through that, and Ike manages the full-time trader room, and does a lot of micro futures and all kinds of different trades. And he's been trading for many, many, many years, and he manages his own trade group with his family, and he's just a great trader. And so super good environment to be in, and you can learn a lot, with them. Okay, all right. So real quick, if this is for you, if you want to learn a step-by-step process to gain income in a market that goes up and down, you'll finally break those series of losses and drains account drains, and you earn consistent money, this is for you. Okay, so what you get, $20 off for life for joining today. A professional traders group, subscribers, trade chat group that we have, live traders in there that trade for a living. We have education channel. We have automated signals that come from, most of the trades come from me and my brokerage, and they come out between 20, 30 seconds, and you'll get that alert. Trade entry, fill price, we share with that, the price target, the adjustments, and my guarantee that you'll make money. So you can't lose. You can't lose. So any questions? Let me see if we have questions out here. Let's see. Okay, so I got some question. All right, Al rolling. Here we go. Al rolling down. Rolling down. Don't you worry about markets staying down for an extended period of time. Yeah, markets go down. They don't go down straight down, right? So you'll get times where the market is going down, and then it starts moving up, and that's where you can get out of your trades, and it happens a lot. These trades are 18 months old. How about new numbers? yeah. I think I should get new numbers on these guys. But honestly, these scenarios are very, very similar to these older trades. But you're right, Bill. I should update my stuff. Okay, can you show current trade alert and how a Telegram service looks like? I think so. Let's see here. Oh, I have to share different. Yeah, I can share different. Okay, we got a little time. All right. Let's see here. Let's do. Window. Okay, here you go. Okay, so here's an actual. Here's an actual scenario. I'm going to go to 0 DTE. So this is the 0 DTE area. Okay, right? And you can see here that I traded today a call side, 70 cents. I put it on at 9.38, and I put on the put side for a 55-cent premium for 9:39 a.m. And because there's not an extended trade after that, these trades expired worthless. Yesterday we had a stop loss here. Closed it out at 195. The market was going straight up, and that's what we did. We have 7 DTE trades here. We have monthly trades. We have options on futures trades. This was a options on futures and closed at 10 cents. Futures trades, premium trades. This is what Ike trades. And then he trades futures as well, micro futures. And that's how it is. So that we have the trade chat. Here is the, Here is the subscriber trades, and you can see where we have several guys in here that put their trades on, and these guys they trade for a living. Okay, in here, and they put out really good trades. So that's how it works. All right. Okay. Can you show? Okay, I showed you that. Is there a feature any brokers that allows you to see rolling option different dates? Are you going to find optimal? I'm not sure about this. Let me see. Al, is there a feature with any brokers that allows you to see rolling options at a credit with different dates widths. Yeah, Tasty Trade does that. I mean, I'm using Tasty Trade now. So yeah, you can see the rolls in there, and how far they've gone. I think that's the most sophisticated for for brokerage on Tasty Trade that does that. So you might want to check that out. How do you calculate profit and loss? We have we actually have performance data, but I moved from Thinkorswim to Tasty Trade, and we are working on it as we speak. But it's taking a long time to redo it. So we're going to have that performance back, and hopefully within a month. The way that he explains so far. Loss of threatened trade. I'm not sure about that one. How do you calculate profit and loss? Okay. Okay. Can you roll a spread on ES? Good question. You can, but you have to do it within the same expiration, and so that could be a little dicey. So definitely, I use stop losses on ES on options on futures. Okay. Can we trade SPY? Yes, you can trade SPY, but we don't trade it here. A lot of people will take it, extrapolate from it, and trade SPY. But I don't actually trade SPY, but it works the same. You just have to be cognizant of getting assigned. Okay, because you can get assigned with SPY. Let's see here. Are we learning how to find the trades and just executing alerts? Yeah, well, I mean, I'm giving you the deltas, and I'm giving you everything that you need to know to do it on your own. And learning by doing helps you a lot. Okay, instead of just trying to figure it out. I moved from Tasty Trade to Toss, from Toss to Tasty Trade because there was a problem with me trading with them. Okay, so long story. I moved, and everything's the same now. All right, so I think we got it. Anything else? I think we're cool. All right, guys. So thanks for hanging in there. Hopefully I'll see you in the trade room and making money. All right. All right, guys. Thanks, and have a great night, and hope to see you there. Thanks. Bye.